Good afternoon to the folks that are East Coast. Good morning to those who might be in another time zone with us. I'm going to go ahead and get us started this afternoon. I believe it's right at 1 o'clock. So we will get started here in just a moment. Before we start this day's session, I just wanted to open with some opening remarks. For those of you that don't know me, my name is Matthew Saha. And I am an audit partner and leader of Cherry Bekaert's not-for-profit industry group for the firm. And I want to thank everyone for joining us in this first session of Cherry Bekaert's 2022 not-for-profit speaker series. This year, we've been continued to be inspired and humbled by the efforts of the not-for-profit community to tirelessly fill the gaps of the declining program revenues, donor support, and funding that we're seeing. And that's why we're trying to offer this not-for-profit speaker series, of course, to you always free of charge and for your CPA needs. So we've heard your feedback, and we have changed the format of our speaker series after we've held long-standing annual seminars, both virtually and in person, which are condensed into maybe a day or two. We've heard you, and we're going to be presenting going forward, doing these speaker series. It's our hope to meet you where you are and provide quality industry-specific CPE at convenient times, free of charge throughout the year. So we hope that this change eases the burden and time commitments for you and makes it easier for everyone to participate. This speaker series is intended to provide not-for-profit leaders and with tools necessary to embrace a more innovative mindset and achieve increased organizational agility. So we're really happy that you're able to join us over the next several months in 2022 and continuing this speaker series for years to come as well. So please make sure to bookmark this, and we'll have information here on upcoming speaker series as well. Before we begin, I'd like to just make sure we all are clear with some housekeeping items. To receive CPA credit, you're going to need to answer at least 3 polling questions throughout this 50-minute presentation. So make sure you're on the lookout for those. We'll try to give adequate warning, adequate time to respond to them. But if you do need CPE credit, it's very important that you guys answer those. We will issue CPE certificates, and those will be sent to you via email within 10 days. If you've not received yours after 10 days, you can please reach out to us at cbhlearning@cbh.com. And then a recorded video of this webinar session will be available about 1 week out, and that will be sent via email and posted to our website as well. If you have any questions during the webinar that you want our speaker to answer, we'll be monitoring those, and we please ask you to put those in the Q&A window located on the control panel of the Microsoft Teams. That's different than the chat panel. The chat panel is more for chatting back and forth with your fellow participants throughout the session. If you see somebody else participating that you know, feel free to have a conversation or chat in there. But if you have formal questions that you want answered, we ask you please put those in the Q&A window. And then we'll have a brief survey that will be posted at the conclusion of this webinar. We value your feedback, so please take part in that survey and give us any feedback that you have on the session. Now, with all the housekeeping items in order, it is that time to hand it over to our first speaker and introduce hopefully someone that you know well. This is Amanda Adams, who is our managing director with our not-for-profit tax services group. She'll be presenting our first session, very timely, on a not-for-profit tax update for the year. And as I hand it over to Amanda, I'd be just remiss if I didn't start with a joke. So Amanda, did you know that the first French fries were not cooked in France?
No, Matthew, I didn't know that.
Yeah, they're actually cooked in Greece.
Ah.
Greece, yeah. So Amanda, without further ado, I hand it over to you. Thank you.
Thanks, Matthew, and thank you everybody for participating. Sometimes taxes can be dull, but I'm going to try my best to keep things interesting and focused on things that'll be impacting your organization. So we'd like to kick things off with just a first little polling question. we wanted to find out how you heard about this year's not-for-profit speaker series. So we're going to give everyone a minute or so to put in their answers. All right, so it looks like we've got a good mix of current clients as well as others who received an email, and a handful of people on social media found out about it. Well, however you found out about it, we're glad that you're here, and we're going to keep things moving. So the first thing I wanted to talk about was some current legislative provisions. Now, it's been sort of a quiet year compared to, years in the recent past where we had things like the Tax Cuts and Jobs Act, the CARES Act. We do have just, really one major piece of legislation that we want to talk about, and then some proposed legislation that might be affecting the not-for-profit group. So the first item we're going to talk about is the Inflation Reduction Act. And so its name is a little bit of a misnomer because I think it was just named that to be to sound like good legislation, but it isn't really focused on inflation reduction. But kind of a key piece of that legislation that might be of interest to many nonprofit organizations has to do with an expansion focused on impacting climate change, and by promoting sort of tax benefits around moving to clean energy, there are some changes and expansions there that could be a benefit to nonprofit organizations. And so the main categories of the clean energy credits have to do with solar rooftop installation, wind energy, battery storage, and things like that. And then there have been some that really are expansions of existing legislation, but what's really of interest to nonprofits is how can these tax credits actually be converted to a benefit for organizations that don't really have a tax liability. So in the past, a lot of times nonprofits would have to partner with for-profit organizations sort of in like a joint venture situation. So, the for-profit entity would essentially get the tax credit, and then that would result in like a reduced charge if they were partnering with them on developing a project. So the legislation has changed that, and now that it's allowing for a direct pay option, which means that assuming the nonprofit qualifies for the credit or rebate, they will be able to receive that amount as funding directly from the government, rather than having to, partner with an organization or have a tax liability of its own to apply the credit against. So that's very positive. Another change is this new alternative minimum tax on large corporations. So large corporations, and this is defined as ones that have over $1 billion of book income, will now be subject to this 15% tax. So helpfully, they have explained that this would only be applicable to a nonprofit organization if they had $1 billion of book unrelated business income. So there may be one or two nonprofits out there that could potentially have that much, but I'm not aware of any of them. So the good news is that this won't really affect the nonprofit sector by much. The last piece is sort of an unknown. I can see the good and the bad in it. The IRS has been struggling, ever since the beginning of the pandemic with remote working. Their aged technology has caught up with them, and they have struggled with, minimal budgets for many years. And so this increase in funding, I can see the good in that maybe they will be able to hire people to pick up the phone when I need to call about, a notice. But some organizations are concerned that this increase in funding will result in more examinations or, could have negative repercussions. And, the IRS commissioner has come out and promised that they won't be targeting, low to middle income individuals, that really they're going to be focusing their efforts on businesses with large profits and high net worth individuals, and not going after people that really should have minimal tax liability to begin with. So let's talk a little bit about some pending legislation that might affect the nonprofit sector. And so that pending legislation is, first, we're going to talk about the Universal Giving Pandemic Response and Recover Act. So we'll go a little bit more in depth on this later, but the changes to the standard deduction for individuals as part of the Tax Cuts and Jobs Act really did reduce the number of individuals that were actually itemizing their deductions. And so that meant that individuals that weren't doing that were really not getting much of a tax benefit for any charitable contributions that they made. So there was this effort to, kind of have a minimal sort of like extra on top of your standard deduction charitable contribution, but it's kind of minimal. So this act would propose that that would be extended into the future and increased to be equal to a third of the standard deduction. So this has a lot of support from both sides of the aisle. So it's possible that this could be something that we would see actually be enacted if it can be tacked on to something else that is going to be passed soon. The other item here is the Nonprofit Sector Strength and Partnership Act of 2022. This one's a little bit unusual because it's not really around deductions or tax benefits. Basically what it is to facilitate collaboration between representatives of the nonprofit sector and government agencies so that there's a better sharing of information, data collection about various industries, and also they would open the lines of communication so that the people in the government responsible for enforcing laws would understand how the enforcement of those laws impacts the nonprofit sector. So like, for example, we'll talk a little bit about some recent relief that almost completely bypassed the nonprofit sector. And, being an optimist, I like to think that it wasn't intentional that they were left out. It was really more a lack of knowledge and awareness of, the issues that they're facing and how they fit into the entire picture. So I can definitely see this as a positive. The Accelerate Charitable Efforts Act, this is one that has been around for a while. It seemed like it had some steam, but it really has fallen to the back burner lately. And this act really is focused on trying to move funds held by donor-advised funds and private foundations out to public charities in the sector much faster. So there are a lot of tax, penalties and benefits, but that would shape how donor-advised funds and private foundations are operated. But generally speaking, all of those would be around trying to push funds out of those entities much faster. Because right now, a donor-advised fund does not have a technical distribution requirement. A private foundation does, but they're also concerned about interactions between private foundations and donor-advised funds that they feel further delay the distribution of those funds. It seems unlikely that this will go anywhere anytime soon. It's very detailed in its suggestions. It's possible that one or two things may come out of that if it can get combined with something else. So let's go to our next polling question. I'd like to find out how your organization's financial position has changed during the pandemic. So I know it can be hard to judge, given that there was a lot of pandemic funding that organizations qualified for, that hopefully your organization was able to take advantage of to get some relief. I know that the giving situation, varies. There are some donors that are trying to give more to help with that. And then others are, kind of seeing discontinuance of funding from certain sectors because businesses, for example, are, trying to focus their resources on themselves. So we've got about few more seconds, but it looks like we're kind of split between it's about the same, better now than before. Just a small percentage, about 15%, are saying that it's worse now than before. All right. So the state of the IRS, this is always something we like to, kind of touch on just because it's helpful to understand, what position they're in right now, looking at the nonprofit sector, as well as kind of what are their goals going forward, what are they going to be focusing on. As I mentioned before, they really are seeming to struggle with maintaining a good workforce that is trained. I can tell you from personal experience, it's very difficult to get anyone on the phone right now. Many times I'll call and I'm told that they can't even let me hold at all, even though I might be willing to hold for 2 hours. They will just say, try again later. And then even when you are able to get through to someone, they basically have some people that I think they're referring to as a part of a surge team. So they've come in, but they're new, they may have undergone limited training. So all that to say, right now, it's very difficult for anyone to get through and to be sure that the person you're talking to is knowledgeable about your issues. So that's certainly something to think about. If you call and you get something back from the person you're talking to that doesn't quite seem right, that's definitely possible given the situation right now. So the updates to the tax exempt government entity division, they are continuing to work remotely. There are the processing centers have opened somewhat, but they're not back to full capacity as far as the staffing in the centers. There has been an increase in the availability and the mandatory nature of electronic filing for returns filed by exempt organizations. So that's definitely good on the one hand. It reduces errors to electronically file returns. And you don't have to worry about going to the post office and getting a proof of mailing. But it also has highlighted the issues with many organizations that may have been filing on paper that thought they had exempt status or had exempt status under a different section, that now that they're trying to electronically file their return are running into trouble because they're not in the IRS database under the same code section that they believe they should qualify under. Also, the smallest organizations that may have been, let's say, preparing their Form 990EZ themselves are now having to, look for electronic provider solutions to be able to submit those returns electronically. So the IRS has been able to make some new hires, not as many hires as the previous year. And so this has actually resulted in a net attrition of about 5% of personnel. So despite their best efforts of trying to hire new people, their actual workforce is down 5% from the last year. So the next thing wanted to talk about that the IRS is focused on is really investing in collaborative partnerships. So they are trying to focus on enhancing their information technology by using digital communications processes. So this is something that they're trying out in the tax exempt bond section. So this is where they are trying to basically allow for communications between IRS agents and taxpayers to happen through email and secure portals versus having to mail and fax in items. So I think if that all goes well, that will be great for the rest of the sector, because we all know that we're an email world now. Nobody really wants to have to deal with a fax. They also have created some sort of automation processes for certain things like email referrals. So, that is a very common way that nonprofit organizations are selected for examination. And that's basically someone complains about them to the IRS by making a referral and saying, you should look into this charity. And so now they have an automatic process to take those email referrals and get them logged into their system and transferred to the people that will ultimately look into them. They also have a partnership between the exempt organization group and several of their other groups, like the small business, self-employed, large business and international group, the research, applied analytics and statistics group, and their criminal investigation group. So the main focus, with some of that partnership has to do with syndicated conservation easement cases where they're sharing data between all of those groups to better prosecute those. But they're also focusing on a linkage between high income, high wealth taxpayers and exempt organizations. So those could be donors, board members, some kind of connection between that individual and an exempt organization. And so they're looking at, where those overlaps are to see if there might be something that they want to look into further. So the examination rate does tend to be fairly low. This is about the same percentage as last year. There are a lot of exempt organizations, and that number is growing every day. And as you can see, with only being able to process a few thousand cases per year, that really represents an overall very tiny fraction of exempt organizations overall. So the cases that they looked at, they had almost 100 proposed revocations of exempt status, which is, of course, the most significant tax change that can occur. Some of those had to do with the organizations not being operational. So if they're dormant, they're not really doing anything, then they're not going to continue to qualify for exempt status. Short of revocation, still they did find some kind of a change in about 82% of the cases. So that means that the ones they are selecting, they are finding issues and they are challenging organizations on those issues. And then in terms of reinforcing the importance of the partnership, the collaboration with the other groups, about a third of the examinations were picked up from another examination of another taxpayer. So that's always important to keep in mind, that it could come through a connection to another individual or company. So data-driven examinations are examinations that are based on an analysis of the data found in the nonprofit's annual filings, the 990, payroll tax returns, things of that nature. So the examinations there had to do with unrelated business income. So probably looking at metrics on the Form 990T as compared to the 990, and then filing requirements. That is just when organizations are not filing the appropriate return or not filing a return at all. Compliance strategy examinations are examinations that are focused on a specific area. So the areas that the IRS has identified that they wanted to focus on are hospital organizations that have unrelated business income where the expenses are greatly exceeding the income. So clearly they're looking at something like whether the expense allocations are appropriate and whether they're potentially allocating exempt programmatic expenses incorrectly against unrelated business income. Also looking at social clubs that have investment income, which is considered to be unrelated business income, and non-member unrelated business income. They want to make sure that those clubs are not taking a loss from their non-member activity against their investment income. Private benefit and annulment continues to be a high focus for the IRS in looking at whether organizations are receiving excessive compensation or in some way improperly benefiting from their relationship to a charitable organization. And then the last area they're focusing on is on charitable organizations that used to be for-profit organizations, of course, to make sure that they're in compliance with the requirements for charitable organizations. So let's move on to a polling question. I'd like to know how many of you have had your organization examined by the IRS. So we saw that the percentage for the most recent year reported by the IRS was only about 0.17% of all exempt organizations. So I wanted to see out of our participants how many had actually gone through an examination at some point in the past. So it looks like about 15% of you have answered that you have undergone an exam, your organization has been examined by the IRS. So, that is a little bit more than the, the 1 year snapshot, but given the passage of time, of course, it makes sense that there would be a higher percentage. Okay. So moving along, we've got, wanted to talk about sort of the determinations process. And what that is the process for organizations receiving recognition of their exempt status. So this number, 94,000 applications closed, is fairly consistent over the past 3 years. So you can see that, out of approximately 2 million exempt organizations in the universe, we're adding to that of about 100,000 entities per year, which is quite a large number. And part of the reason that is possible is because there is a new streamlined process for application for exempt status, and that's the 1023 EZ. It's very simple. It has a lower user fee. It's meant for smaller organizations, and it only takes the IRS about 4 to 6 weeks to process it because there's very little information provided. And as you can see, about 70% of the applications received last fiscal year for the IRS were these 1023 EZs. But is that necessarily a good thing? So I wanted to show 2 perspectives on that. In a recent IRS column posted in September, the commissioner of the tax exempt government entities group is quoted as saying that the 1023 EZ has reduced the burden on the smallest organizations applying for tax exempt status and increased the efficiency of the EO division's operations. So it certainly has increased efficiency because it takes much less time to process the 1023 EZ. However, we have to balance that with the fact that there are a lot of tax benefits granted to an organization that has exempt status. And this really could open up lots of potential for fraud and other issues. So in a recent article published by the New York Times, they were focused on this individual who had created 76 fake charities, all with the same mailing address. And most of those he had filed a 1023 EZ. He had used names that were similar to, recognizable charity names that you would know, like, American Heart Association, Red Cross, things like that. He had basically created all these fictitious charities to solicit funds, and people, not realizing that, it sounds like it might be, a charity that I'm used to dealing with, but it wasn't really. And so I think this highlights some problems with the IRS process in that, there was no red flag that was thrown with all of these charities having the same mailing address, the same director. In some cases, NA was put in spots that should have had information. So I think, we really need to see if this is going to be something that continues, or if the IRS is going to kind of tighten up their procedures in this area. Compliance checks are basically, a little bit softer kind of contacts by the IRS. So sometimes they may issue letters, kind of notifying a taxpayer of, a problem, something they've seen. A common one is kind of the old discrepancies between, the W-2s that are filed with the 941s that are filed. If those numerically don't agree, you're going to get a letter about it. They're also focusing on exempt hospitals that are not complying with financial assistance policy requirements, failing to file certain forms, organizations that have credit balances but missing employment tax returns. So these are all little things where the internal systems can, flag something, and they're reaching out to people about it. So the IRS, part of their job is also focused on educating taxpayers, and they began a few years ago posting what they called issue snapshots, focused on exempt organization issues. And so these are areas that they feel like need, more information to be shared with taxpayers to be sure that they're aware of the issues that they may be facing. And so a lot of these in recent times have been focused on private foundations, self-dealing issues, treatment of qualifying distributions, things like that. The other kind of areas that they focused on recently had to do with the correct treatment for tax purposes of contributions to 457B plans, highlighting issues with advertising unrelated business income. So these are nice, good things where you can kind of, see in one place sort of the IRS's analysis on an issue and the things that they think that you should be aware of and focused on. So looking ahead, their compliance program has really not changed much over the past few years. They're continuing to try to remain a taxpayer-focused organization, develop their workforce, continue to leverage technology and data analytics to improve operational efficiencies, ensuring awareness and collective understanding, and of course, strengthening compliance activities. So, they are trying to serve taxpayers better, but in order to do so, obviously, they've got to hit some of these other areas. So their strategies, again, can remain fairly similar to last year. They're focused on worker classification. That's always an area where they can, enhance compliance. That means whether people should be appropriately treated as employees rather than independent contractors, whether organizations that are filing a 990N should actually be filing a longer form, and continuing to look at the excise tax on excess compensation and making sure that people are in compliance with that. So now let's turn to the more interesting issues, I think, and these are just some other developments that have popped up in the sector. So the first thing I wanted to talk about is exempt hospitals. So they have really been under the microscope lately. And the information in these various sources is interesting. So the first study that I looked at was focused on how much public charities actually benefit from being exempt. And it was interesting in the data that they looked at, they discovered that most public charities actually don't get much in the way of a benefit from being tax exempt because they don't generate net income. And so only those organizations that actually are profitable get a benefit by not being taxed on their profit. So when they were looking at that group, they found that exempt hospitals compared to other nonprofits benefit a lot from having that exemption, as the hospitals they looked at earn substantial income. And then we have another article coming out the same month that's focused on whether exempt hospitals are really providing charity care as they should be doing to maintain their status as 501c3 organizations. And the analysis that they did said that charity care provided by exempt hospitals was actually less than for-profit hospitals, which is surprising. And then another kind of amazing article that came out recently was focused on a very large hospital chain. And they were basically looking at how this hospital was operating. And they did not believe that it was operating consistently with exempt status because it not only was its charity care less than 1% of its expenses, but it was sitting on about $10 billion of investments. And so that does not seem like what we would expect from an organization that should be focused on making sure that the most vulnerable populations can receive health care without, paying an exorbitant amount. So I didn't have time to put this on the slide before we finalized the presentation, but there was another article that came out recently from the American Hospital Association that was talking about how hospitals are really losing money in 2022. Their margins are down 37% from 2019. And the rising labor costs are what are really driving them to, be losing money each year. So I think it's a very complicated picture, but the best thing I could suggest is that if you're with a hospital organization, to just remember how important the data that's presented in Schedule H is to help with any analysis that the IRS might be doing to be sure that your organization should continue to remain exempt. In order to be a charity, a hospital has to have some sort of charitable activity. Promotion of health alone is not enough to do it. There has to be some assistance provided to a charitable class. And that's what the Schedule H is really trying to demonstrate, as well, compliance with Section 501R. All right, so earlier I alluded to the fact that, the nonprofits were kind of left out of some recent penalty relief, and that is this Notice 2022-36, which provided relief to many taxpayers who were filing 2019 and 2020 tax returns late. And you will see a couple of nonprofit returns in there, the 990T and the 990PF. But the specific penalty provision that was provided relief for was not the typical late filing penalty that is a daily filing penalty for the 990 and 990 PF. But in fact, it was just the penalty for that's based on the tax liability of the 990 PF. So that typically is a very small fraction of the overall penalty when you're looking at something that's a year or two late. The other issue was that the notice came out not very long ago and stated that the returns had to be filed by September 30th of this year to qualify for relief. So, it's not helpful to find out a month before something is due that, you've got to comply to qualify. So the AICPA has reached out on both fronts. First, to ask that all exempt organizations qualify for the relief, so including that late penalty based on a daily rate for 990 filers and 990 PF filers, but also to expand the due date to qualify to December 31st. So we'll see if this request falls on deaf ears, or if the IRS does respond to expand the relief. I certainly hope that they do. So let's talk a little bit about what charitable giving looks like. And so this Institute for Policy report, Gilded Giving 2022, was kind of focused on how things have changed since the Tax Cuts and Jobs Act kind of changed the deductibility by expanding the standard deduction. And so this report found that now fewer than half of all US households give to charity, and that the share of households that claim charitable deductions fell significantly after the TCJA. But what has expanded significantly is top-heavy philanthropy. And what that means is that the households making the most money are giving more. So for example, in 1993, households making over $1 million just accounted for 10% of the total charitable deductions in that year. But in 2019, households making over $1 million accounted for 40% of the charitable deductions. So you can see that the overall proportion of charitable giving is in those higher income households. Another thing that has really increased is mega giving. So the threshold that Giving USA placed on a mega gift was $30 million, and gifts of that size in 2011 were about 2.7 billion in total. By 2021, just 10 years later, the mega gift threshold was now defined as 450 million, and gifts of that size or larger added up to nearly 14.9 billion. One concern that people have around that is whether the activities of charitable organizations are going to be unduly influenced by a smaller proportion of donors versus having a really representative cross-section of the public. But the other thing to keep in mind is that these large donations are really, in most cases, going to private foundations and donor advised funds, not to, a community charity like the United Way. So the Chronicle of Philanthropy published a list in 2022 of its top 50 philanthropists, and of the $25 billion that that group of people donated in 2021, 69% of it, more than 17 billion, went to private foundations. And then the next largest chunk, more than 2.6 billion, went to donor advised funds. So it's no surprise that contributions to donor advised funds are also on the rise. In 2020, for the first time, donations to donor advised funds caught up with contributions to private foundations. Both received roughly $48 billion from donors that year. The largest recipient of charitable giving for the past 6 years has been the Fidelity Charitable Gift Fund, a commercial DAF sponsor. So the report is concerned and suggests that the U.S. needs to overhaul the rules governing philanthropy to discourage the warehousing of charitable wealth, to align tax incentives with the public interest, and to encourage broad-based giving across all segments of society. So again, we've kind of got a link to that, the ACE Act that I mentioned earlier, this focus on making reforms to donor advised funds, encouraging them to pay out. This report encourages DAFs to pay out the entirety of any donations within 3 years of receiving them, including any income that those donations have earned, and to increase DAF transparency and reporting. Private foundations, they suggest, should have their annual payout requirement increased to 10% from 5%, and then also looking at potential exclusions for what can count. So it'll be interesting to see if, this report goes anywhere, but I would definitely keep an eye on the potential for changes in private foundations and donor advised funds in the future. Another interesting thing that's come up recently has to do with the applicability of Title IX to private schools. So, the general rule has always been that Title IX, which is a federal law prohibiting sex discrimination in educational programs, only applies to schools that receive federal financial assistance. So I know that some organizations, when that did not typically receive governmental assistance, were concerned about accepting, some of the CARES relief and how that might impact whether they were subject to Title IX. Well, these two recent cases basically made the case that tax exempt status is equivalent to federal financial assistance, which means that any exempt school would be subject to Title IX, whether they actually received any dollars from the government or not. So many people in the legal community think this is an overreach. This is an unusual situation. It's really disrupted many years of commonly settled law. So this may be something that is challenged in the future and doesn't hold, but it is definitely something for schools to keep an eye on. If you're not already required to comply with Title IX, could be something to have on your radar. Okay, polling question number 4. Have you noticed a change in the type of charitable giving received by your organization in recent years? All right. Let's see. Looking like we're kind of evenly split here between yes and no. So that's interesting. All right, so we've got about 15 minutes left. So we've got to leave that poll open a little longer, but I'm going to move on to our next slide. So I'm sure any of you who follow sports are well aware of, this new policy that came out last year. The NCAA approved a policy to allow certain student athletes to be compensated for their name, image, and likeness. And so anybody who's, very interested in college sports, it's always been a conundrum that, the popularity of those athletes, it was not something that they could capitalize on. So it's kind of like a quandary, because educational organizations derive their exempt status from the promotion of education, right? But sports has always kind of been sort of in a gray area, right? It's supposed to be an educational activity. We have amateur athletes, and so it's going to be interesting to see, as these kind of the development of policies around NIL, how are universities going to balance that with kind of the concept that they should be an educational organization. So many universities have kind of started helping players secure compensation relating to NIL, an arrangement that they may or may not be a party to. So these could be joint ventures. The university is partnering with a for-profit entity, or the student. There are grave concerns around whether any activities that are focused on promoting compensation for the student athletes could potentially result in unrelated business income to the university. So there have been a growing number of collectives formed as both nonprofit organizations as well as for-profit organizations around this. So right now, kind of what we're seeing is there's a few different types of these. So one is called a marketplace collective. And this is where the organization is trying to create kind of a gathering place for athletes and businesses to connect and create opportunities. And that they might even be serving as an agent representative for the athlete. Then there are donor-driven collectives, and this is where they're kind of pooling together booster and other supporter funds and trying to create opportunities for athletes to be able to give money back to the organization. And then there are also dual collectives, which is kind of a combination of the two. But I think this is an area, that's growing. But there could be some definite tax impacts. So it's certainly, if your organization is looking into this, it's something that you'll want to involve your legal counsel, to be sure that you're not running afoul of any rules. Because of course, anytime something new comes up, right, there's not a whole lot of guidance to compare what you're doing with what is allowed. The other thing to keep in mind is I feel like in the past, there's always been a lot of latitude provided to sports organizations, such as the exclusion from unrelated business income for qualified sponsorship payments, all was derived, from college sports. So I'm sure there'll be somebody pushing for whatever the desired outcome is. But again, it's always good to be prudent. So it wouldn't be a tax update if we didn't have a cautionary tale regarding a contribution that went wrong, right? So in this case, what happened is a couple decided to create a donor advised fund, and they had an upcoming transaction that was not settled, but they knew that they would have, something of value to contribute to the donor advised fund. So they signed the paperwork to create the donor advised fund. And then a little while later, they actually made a transfer of a 4% partnership interest. Now, the transaction that was in process was that the partnership was looking to sell substantial assets to a third party. Now, at the time of the gift of the interest, there was not a binding contract. It was just kind of in an exploratory period. But the appraisal of the partnership interest that was obtained for the donor's tax return and submitted with the tax return mentioned that there was an oral agreement between the donor and the donee that the donee would only share in the net proceeds from the closing statement, not the other assets of the partnership that weren't part of the sale. So the court found a few problems with the donation. First of all, the fact that there was an oral agreement to carve out a portion of income from this future transaction was deemed to be an anticipatory assignment of income. So what that means is that you can't claim that the income shouldn't be taxed to the donor because it was part of the interest that was given to the charity. Instead, the income is supposed to be picked up by the donor because it was, essentially attributable to them and they couldn't give it away. The bigger issue really has to do with the acknowledgement of the contribution. So what was asserted is that the sponsoring organization's acknowledgement was not complete because it was really in two parts. So when a donor advised fund receives a gift, it must include in its contemporaneous acknowledgement that it has exclusive legal control of the asset being received. And when the donor set up the donor advised fund, that language was in the agreement that it signed. However, that agreement was signed before the gift was actually made, and you cannot say that you have exclusive legal control when the gift has not been made. Then the tax receipt that they received from the sponsoring organization when the gift was actually made did not have the language that was in the donor advised fund agreement. So in state law of Texas, which is where this was, apparently it is permissible to look at multiple documents having to do with the same transaction all together as if they were executed concurrently. And that was the argument that they tried to make. However, in this case, the courts decided that that was not reasonable, that 170, which is the code section that provides for the deductibility of charitable contributions, has a very strict interpretation in that it may look at multiple documents, but is not required to. So all that to say, we really need to be careful in this area because IRS examiners continue to be focused on non-cash contributions and ensuring, that the tax receipts are contemporaneous, contain all the language they have to have. If a qualified appraisal is required, that the donor has that qualified appraisal. So they're really focusing on just very tiny footfalls. So it's more important than ever to be sure that you're in compliance with providing those contemporaneous tax receipts, that the language that is required to be in the tax receipt is complete and accurate. And then also to remember that you're in compliance with Form 8283. So that is a donor-driven form. They are completing that form to attach it to their return to be able to claim certain non-cash contributions. There is a section in that form that is required to be filled out by the charitable organization recipient. And the key components there are: one, you are affirming that you've received the non-cash gift. And then you have to affirm whether you are going to use that gift for your charitable activities or not. And that really is more critical around tangible personal property like artwork or a vehicle, because the amount that the donor may deduct depends upon whether the charity is actually going to be using it in its exempt activities. Then it would be at fair market value. But if the charity is just going to sell it, then they would be limited to basis in most cases. A common misconception that organizations have is that by signing that donee section, they're affirming to the fair market value that the donor is claiming, and that's not the case. It's really just those two pieces of information. Have they received it, and how are they going to use that property? So something I've seen in the news, just wanted to call out, is that, with the rise in the employee retention credit and the applicability of that to so many organizations, we've seen a number of these kind of tax consulting firms that have popped up to help organizations claim these credits. And they have very aggressive marketing tactics. It's important to remember that they may not be subject to the tax return preparer rules, and therefore they may face little consequence for aggressively promoting tax credits that organizations may not be entitled to. And the IRS and FBI may be cracking down on these organizations. Recently in the news, there was information about this raid that they had conducted on a firm called Alliant Group, which is based in Houston. And, typically that's not how, the IRS would approach an organization that they had concerns about. But basically they went in, gathered their documents. It was highly unusual. So we just want to encourage everyone, if you're, working with a firm, to kind of look at employee retention credits or other credits, make sure, that the engagement letter kind of stipulates how they stand behind their work, because that can be very important. Someone that is, not really doing the due diligence on making sure that the organization indeed qualifies for the tax credit. If there's no consequence to them if you don't actually qualify, then, that would be a red flag, because they may just be in it for, the fees that they could potentially earn. Last thing I want to do is remind everyone of mandatory e-filing. So again, all 990s are now required to be electronically filed. 990EZ, 990T, 990. Forms 4720 that are filed by private foundations must be electronically filed. And the consequence is worse than just a penalty. It is, if you file a return on paper that is required to be electronically filed, you have not filed a return at all. Eventually, the IRS will process it. It may take a year, but they will eventually process it and return it to you and say, this return must be electronically filed. Late filing penalties may apply. So that's going to be something to really, be sure you're aware of. There's no waiver. Even for organizations that are having their returns rejected, they've got to work with the IRS's e-file department to find a solution to get it to be electronically filed. That is, there's no special exception for any return to be paper filed. All right, this is going to bring us to our last polling question for today. And that is, which area of tax compliance concerns you the most with respect to your organization? So it's interesting because a lot of times people are focused on unrelated business income. Are they conducting an activity that either is currently taxed or they think could potentially be taxed? But in my mind, what I see more often as far as an issue that the IRS seems to fall upon easily is around employment taxes. So that's an area they're very familiar with. It's an area where it's easy for people to have a misstep and easy for the IRS to collect additional taxes. The unfortunate part is that a lot of smaller organizations, of course, find it easier to pay people as independent contractors than to, set up the whole payroll withholding and filing system. And unfortunately, that's really, what their systems are designed to find is the improper treatment of people as independent contractors. All right, so we have a couple minutes left. Let's see if we've got anything in the Q&A section. Okay, we've got one quick question I can answer. Are extensions required to be e-filed? Actually, they're not. So extensions can still be paper filed, but there is a benefit, of course, with e-filing extensions in that, you get proof that it was filed timely and you don't have to mail them. But technically, yes, you can still paper file them.
All right. Well, thank you so much, Amanda. Really appreciate all the time and effort that goes into preparing these updates. Super informative. I know I learned a lot today and I'm looking forward to my CPE credit for this session. So really thank you for time and thank you for everyone for joining us for the first of our not-for-profit speaker series sessions. Again, we value your feedback and we ask you take part in that short survey that's going to be sent out. That will appear after you leave the session. So look for that to pop up directly. Just takes a few moments to fill that out. And then also just a quick reminder to check out the registration site for our upcoming sessions and recordings that will be shared in perpetuity there on our website. So The next one will be Wednesday, October 12th. You'll be stuck with myself for a FASB update. So that's just coming up next week. So I look forward to seeing everyone there, and have a great rest of your